Happy Monday, state of the market. As always, we guys bring you what the economists and experts thinking about interest rates, sales, home prices, and all the important stuff you guys are looking for. We got Humaira 2 days in a row.
All right.
I'm a lucky
Great.
man today. How you
Happy to
been?
be here. Good weekend. What about you?
Can you hear me? Did you freeze on me?
No,
Good, thank God.
yeah, we're
You
good.
busy?
All
You
right.
lagged a bit, but it's all right. As long as
Relax.
you're with us, let's go ahead and share the first slide.
All right. I'm gonna go
So
ahead.
today, guys, it's going to be about interest rates. So obviously, we see the interest rates creeping up a bit. Let's see what the economist says about the interest rate. So 2021, we've got a first quote from the chief economist Ed Zanda, Ali Wolf. The single biggest risk to housing is rising mortgage rates. Is a real possibility in next year, and that could bring a price down. Further, other economic, financial, and confidence challenges could also result in a drop or flattering, right, of home prices, even with solid buyers in place. But a drop or flattering in home prices is a far cry from the crash we saw during the Great Recession. Okay, perfect. So obviously, the higher the interest rates, the higher the monthly payments, obviously the buyers won't be able to make continuously making these crazy offers with the rates being higher. Okay, let's move to the next one. All right, this is our favorite Freddie Mac 30-year fixed rate mortgage rates
Yeah.
chart, right?
Mm-hmm.
You can see this one is being run just for this year, right? So it's from January 2020 throughout today. And as you can see, right now they're sitting at 3.01%, which is definitely on rise, right? Comparing to what they were just a couple of months ago, right?
Mm-hmm.
So that definitely it's an increase, but still relatively amazing rates. Move to the next one.
It's another quote.
Go ahead, you can read this
All
quote
right.
time.
It's by Sam Cather from the chief economist at Freddie Mac. Mortgage rates jumped above 3%. Many factors led to this increase, including the Federal Reserve communicating that it will taper its support of the capital markets and broadening in inflation and emerging energy supply shortages, which compound other labor and material shortages.
Perfect. So chief economist over here at Freddie Mac is breaking it down for us, right? What are some of the factors that actually led to the increase of the interest rates? And it's all of the above, right? You got the
Mhm.
capital markets, you got obviously everybody's trying to broaden the inflation and emerging energy supply. Okay, perfect. Next one. Perfect. So mortgage rate projection, that's my favorite because it's so clear to see, right? So these are all the big boys, right? You got the Freddie Mac, Fannie Mae, MBA, Mortgage Bankers Association, and National Association of Realtors. So these are projections from 2021 Q4, which is we are in already.
Mhm.
Then you've got 3 quarters in 2022. So as you can see, everybody are calling for increase. They're not the
Mhm.
same, right? But when you look at average of all four of them, so we're expecting about 3.2 to wrap up the 2021, and then you can see the rates are going up, right? Q1 at 3.3, Q2 touching the 3.5, and Q3 way above the 3.5%, right? So again, we knew the interest rates are going to go up. They're not going to stay in 2.875% for forever, right? And look, it's a big difference because if you go from 2.875% to 3.5% next year, you're looking at a couple of $100 a month more in a monthly payment. You're buying the same home, you're paying the same price. However, your monthly payment will go up by about $200 to $300 a more just because of the increased interest rate. Okay. What else we got, Umara?
So we have this other graph, the interest rates.
This is a nice graph, and this is
Mhm.
again from Freddie Mac, right? And shout out to Keeping Current Matters for putting these slides together for us, so we can share them with you guys. And again, that shows you moving forward, and this is Freddie Mac only. Freddie Mac is a little more bullish on this year, are going even higher. So they are projecting 3.4 by the end of this year, and all the way up to 3.7 about a year from now, right? Or whenever we touch Q3. Okay, good one. Next one. And this is what I've talked about, right? That's the buying power. To us, when helping a buyer, it's all about their buying power. And obviously, the higher the interest rates, the lower the buying power, right? So this is a great example of, if you finance a property at 400,000 purchase price with a rate of 2.75%, which is no longer to be found, we were at 1633. Right? When you buy the same property with the same purchase price of 400, but the rate is at 3.5%, let's say, you're looking at a bump of about $150 a month, right? So in other words, the higher the interest rate, the lower the buying power, and the cost of waiting is obviously in hundreds of dollars, which doesn't seem like a lot of money, but when you take $200, right, over 12 months, that's $2,400, right? And when on average a family stays in a property about 7 years, that's about $16,800. So that's already a lot of money, right?
Yeah.
It's actually $17,000 out of your pocket. Okay, good. I love this slide.
Good slide. We have one more quote.
You can wrap it up with the quote from DS News.
All right. Homeownership is one of the fundamental keys to accumulating wealth in America. Hence, why it has been integrally linked to achieving the American dream. Not only can owning a home provide a roof over your head and secure a place to live, but because mortgage payments generally remain fixed while rents may rise over time, a home can also be a very effective hedge against inflation. Together, these features can give homeowners an enormous advantage over renters when it comes to accumulating wealth.
Yep. Yeah, and obviously, yeah, and it's amazing. Like we've done last week, year over year in Long Island, the appreciation was staggering 20%.
Yeah.
The homeowners, they bought homes in a $500,000 price range. Those homes are worth today, a year later, $600,000. So they have built an equity of $100,000. Hence, that's how they're going to hedge themselves against, obviously, the rising inflation, which is crazy. Which is, you can see it everywhere, right?
Yeah.
Do you have any more? Or that's pretty much it.
I think this is the last one.
Any more slides?
Last one, right here.
You froze me. Okay, good. Yep, I see it now. Perfect. So based on price appreciation projected by a home price expectation survey, right? And these are great slides today that we have for you, right? So potential growth in household wealth over the next 5 years based solely on increased home equity if you purchased a home at 350 in January of 2021. Right? So you bought it last year or you bought it early this year, cost you 350. Next year it should be at 391. The following year, $413,000. 5 years later, in January, per home price expectation survey, you should be able to build an equity of $111,000 that you can tap into, right? You can tap into your equity and you can utilize it to either buy down some other debt that you have at the higher interest or get into an investment property, right? Leverage your equity as a down payment and buy an investment property that generates even more cash flow. Okay, I love this. I love this slide. Perfect. Thank you, Humera. Great job. You guys have it. I know it was a lot. Humera, you know what I'm thinking to do now? We can also maybe share the slides with everybody, right? So the slides that we've discussed, we can also share them in another post if anybody wants to download them. But in a nutshell, the interest rates are going up. They're going to reduce your buying power, and ultimately the same home today is going to cost you more money tomorrow.
Yep.
Here you guys have it. Thanks, bud. We'll guys catch you on Wednesdays, this week's deals. Other than that, see you later. Bye.
Thank you guys. Bye.